All right, so today, got a lot to cover. So first, I want to talk about sort of group projects. In Canvas, under People, there is a subtab called Group Projects. And these are organized by section. So this particular class needs to be section 301, but if you're watching the video, you could be in a different section. But go down to your section, and you'll see that there are 7 groups attached to section 301. So what you're going to need to do is by Monday, you need to self-select teams of no less than 5 people and no more than 7 people, which you'll be working on for both the StockTrak project and for the group valuation project this semester, which is, again, 40% of your semester grade. So basically just drag your name into the group. If you found a group, put them in there. One of these 7 teams. We have like 40-something people in this class, so it should be around 6 or 7 teams. If you're not in a group on Monday, then I'm going to put you into a group, but I'm going to give you between now and Monday to start self-forming your own groups. Okay, so talk to your peers in the class, start picking out your groups, and as I said, literally just go into the group, find your name on the left of the list, drag yourself into that group, and hopefully you're in with some other people that you want to be in with for your group grade. Okay, so that is where you're going to basically start filling out your group project grades. Now, next, once you've done that, and you have a group of up to 7 people, then one of your members of your group is going to need to sign up for a StockTrak account. Okay? Now, in the syllabus, there's a specific link that you need to click on or copy and paste into a browser to sign up for StockTrak, because that link is going to associate you with this class. Because there's a lot of people that do StockTrak, and we want to actually just have the people in this class that are in our account. And by class, I have 4 sections, so potentially 28 teams are going to be in that StockTrak account. Now, when you sign up for an account, it's going to ask you for a team name. Just use something that's socially acceptable, right? So, for example, last semester we had a group called the Terp Traders. Okay, so we'll then take Terp Traders. We're going to come back here, and then instead of having 101 Group Project 4, we'll overwrite it with whatever your StockTrak name is. So that way, you'll also be able to identify the other teams, not only in this class, but in your section. All right. So the way StockTrak is going to work is you'll go to StockTrak.com. I was already logged in earlier. So I'll log out. You'll create your account. Again, StockTrak. Okay. Create your account. It'll log you in. Otherwise, you'll just have one username and password for your group. Now, what you'll have to do is whoever signs up for StockTrak for your group is going to have to pay $31.95 either by debit or credit card. All the rest of the group members can reimburse that person. You have 1 account per group. You have 1 username and password for group. All right. Now, again, you're going to be responsible as a group for your own trading. But once you sign up for the account, you're going to have an initial portfolio value of $1 million. Okay? And potential buying power of up to $2 million because you can buy on margin. Okay? And so sometime between now and next week, you should start signing up for this by your group. And then the idea is that trading technically starts today, and then trading ends first week of May, and then StockTrak is going to be graded very simplistically. You're going to be graded based on the teams that are in your section. Okay, so that's why it's important to know which teams are which, so we can figure out who your team competitors are. At the end of the semester, non-risk adjusted, whoever has the highest portfolio value gets 10 points. Whoever's the lowest portfolio value gets 6 points, everybody else in between. So it's pure competitively driven, just like you were a hedge fund, right? So that's the idea with StockTrak. Now, you'll notice that StockTrak has the ability to trade almost anything. You can trade stocks, you can go short, you can go long, you can do options, you can do futures, you can do currency trading, you can do ETFs, most of that is disabled administratively. So I've just restricted it to going long and going short on equities. All right. So if you want to play with it, you're welcome to get your own account. But for purposes of this class, you're just going to deal with equities over the next 3 months. All right. Now, as a group, you must make a minimum of 10 trades this semester. If you make less than 10 trades, I'm just going to put you in last place. You default to 6 points. Okay. So minimum of 10 trades. There's technically no maximum, although it says 400 trades, and nobody's ever done that before. Like, I think the maximum I've ever seen is like 200 and something. But nonetheless, I've also disabled day trading, which basically means if you buy it today, you can't sell it till tomorrow. Okay? Or if you short it today, you can't cover it till tomorrow. So there's no intraday trading allowed. Again, it's a feature they have, taken it out of the purposes of the simulation. So you can pretty much buy just about any U.S. or foreign company with a couple other limitations. Another limitations is $3. No trading in penny stocks. Therefore, the minimum purchase price for a stock has to be $3 a share. Or the minimum to short a stock has to be $3 a share. So if you buy a stock at $3 and it falls to $2.50, you can sell it. But if the stock's at $2.50, you can't buy it back. Okay? So it has to have at least a $3 minimum trading price. You also can't put more than 25% of your original cash part of your portfolio into one stock. So if you start out with $1 million, the most you can put in is $250,000 to any one stock, right? So even on a margin account where you have $2 million of buying power, you still can't put more than $250,000 into one stock, right? And then, as I said, trading is pretty simple. Go up to the trading link up top. Again, all the other stuff is disabled. Trade stocks. I did 2 quick trades earlier today. And of course, it's going to be slow because I'm recording this on video. But again, this is not like a market platform. This is a company in Atlanta. But in any event, try reloading this. Trading stocks. Here we go. So your general options are to buy or sell, short, and cover. All right, so if you want to short a stock, short. If you've shorted it, you want to cover it, click cover. If you buy it, obviously sell it later. Now, let's say I want to buy, I don't know, I like United Health Group, so I'll type in their ticker symbol, or if I don't know their ticker symbol, I can look it up. So I click in the ticker symbol, it'll tell me the current quote. They're trading at $108 a share. So I want to buy 3,000 shares. Market order, which means it'll place it whatever the market price will be. In the real world, never use a market order. The brokers completely hose you because even though they're not allowed to do this, they'll do it anyways, which is they won't give you the best price, right? Because they'll see all the lots that are available and they'll basically give you a terrible lot and then they'll actually pad their commissions with that terrible lot. Now, technically that's illegal, but they do it all the time and it's impossible to police. So in the real world, just market orders are terrible. You just get hosed. So what you really want to do in the real world is a limit order, which is the idea that I want to buy it at 108 as opposed to 108.07. So I won't actually pay the market price. I might put it a limit order a little bit below that, and only when it hits that price or fills at that amount will it actually fill. So one of the other things I could do is I could put a limit order, and then I could change this to good till cancel or good to a specific date. Let's say I want to buy United Health Group, but only on a dip. So I put a limit order for 103. So good to cancel, which means only buy it if it hits that price. Or I can do the same thing with essentially a sell. I can put a sell order that says sell it at 100. So even if I'm not paying attention, if their stock goes into a free fall, it'll sell it when it hits $100 a share. So there's a couple other options you can do as part of your StockTrak. But for simplicity, I'm just going to do a market order here. Preview my order. And it's going to tell me that I spent more than $250,000. It won't let me actually execute the trade. So what I'm going to do is I'm going to then take this down to 2,000 shares. And then it's going to realize that that is something I can do because it's less than $250,000. Preview my order again. I'm happy with it. Place my order. I now own 2,000 shares of United Health Group. So over here, my portfolio, I can click at my portfolio summary, and this will show you. Now, earlier today, just for quick examples, now I don't count. I'm just randomly picking some stocks. But I bought Exxon this morning, and one of the things you're also going to have to do is every time you make a trade, you got to give a rationale, 1 to 2 sentences that you're going to have to turn in at the end of the semester as a write-up. Consider it your transaction cost for why you did the trade. So every time you buy, every time you sell, you got to write 1 to 2 sentences. So my rationale for buying Exxon this morning was that the OPEC minister who runs OPEC basically said oil prices are going to $200 a barrel because there's so much supply that's left the market. The prices are about to skyrocket, and we're going to make a lot of money off of that. I'm paraphrasing the news article, but he did say $200. So I think the oil companies are going to start doing better. So I bought Exxon this morning. Okay? So not saying that's going to happen or not. It's all expectation, but that was my rationale for buying Exxon. All right? So again, if you buy or sell, you got to at least write up a couple sentences. Why'd you buy the stock? All right? So over here, my portfolio rankings, every night they will do a ranking. And you can see that not everybody signed up for a Bloomberg, or sorry, for a StockTrak portfolio. So they're going to take the rankings every night, and then that's going to determine your grade based on the ranking at the end of the semester. So it doesn't matter where you are at any point in time. It only matters when the semester ends in May, where you end up. And it's going to be the ranking on that day for the teams in this class. Now, when you look at the rankings page, you'll only see the portfolio value of your competitors. You won't see their actual buys or sells or what they own. Okay, so you don't get that level of transparency unless you have your account. You can see what you own, but you can't see anybody else's, right? So that's what I said. Sometime in the next week or so, once you've signed up for your team name, we'll go back in and you'll know who's in your section because we'll then update the group names with your StockTrak name. Questions about StockTrak? Yes?
You're allowed to trade options.
You are not. StockTrak allows it. I've disabled it. Yes?
So is our grading for the project, like if we were in last place, even though we were doing the project the whole time, does that affect our grade or?
Basically the question is, your grade is purely based on performance. So if you, it's, like I said, it's real world. You work for a hedge fund, you perform poorly, you get fired. Good news here is you don't get fired, you just get a low grade, right? But nonetheless, that's basically the way you're going to be graded. Now that separates 6 through 10. 5 free points is basically doing the write-ups. So as long as you do your trade write-ups, you get 5 points. So that's the worst you could do is a 6. But if you don't turn in a write-up as a team, then you could technically get a 1. Right? But no one's ever not turned in a write-up, so I don't expect that to happen. Okay. Other questions about StockTrak? All right. So have fun with this. It's actually a really good exercise. And as I said, trading started today. So if you have a team of 6 or 7 people and you have one of your team members sign up, you can start the trading immediately. Final thing I want to make, you're responsible for your own team. So if you have a rogue trader on your team who goes crazy, which actually happened last semester, and one of the team members went in, used the account, started doing a lot of crazy stuff, they ended up in last place because they lost a ton of money, and the rest of the team was really bitter at that person, I have no way of undoing that, right? So basically, you are responsible for creating your own team's trading, access to the account, how the account is to be traded. It's a group grade. I expect people to act responsibly, but nonetheless, you are responsible for your own trading as a team. Okay, so who has access is up to you, and how you trade is up to you. All right, so next thing I want to show you is if you go back here to Canvas, and if you click on the Files section, there's a file folder called Lecture Notes. In there is Lecture Note 1. That's what we're going to be going through today. Generally, the Sunday, sometimes Monday morning before the week of the class, I'll put up the most recent lecture note for the upcoming week. Right? So you'll, at least that's where the lecture notes will be. And then today, under the Assignments tab, is the next assignment, which to go with the syllabus is called Homework 1. It's an individual assignment. It's worth 2% of your semester grade, 2 points. It is due on Monday at 10 a.m. for all sections. So this is the way assignments are generally going to work. They're going to be handed out on Wednesday. They're going to be due Monday before the start of my first class. So it'll be technically live today at 4:30. The reason it's not live right now is because I don't want you to work on the assignment during class. So basically, it'll go live at 4:30, but you will need to use Bloomberg in order to complete the assignment. So just as a quick preview, because we're going to talk about this near the end of class today, but using the equity screening tool in Bloomberg, EQS, you're going to do 2 screens, right? So one of the screens is going to be stocks in the S&P 500 index that have an operating ROIC greater than 20% and a cycle time of less than 50 days. So that's screen number 1, right? And then it's going to give you a list of companies in Bloomberg. You're going to take a screenshot of the result. You're going to upload that screenshot. That's one of the 2 parts of your homework. Then there's a second screen you're going to have to do. You're going to take a screenshot of that one. When you've done that and uploaded it, you've completed your homework assignment. Now, what's going to be important here is that you're also going to have to create these custom fields in the Bloomberg database. And without these custom fields, you won't be able to do the assignment. So part of it is you have to go in, create the custom fields, then create the screens against those custom fields, and then show me that you got the right answer with the data. Okay? So I'll just make a point that we are still in the drop add period. And if you don't want to use Bloomberg on a continuous basis every single week this semester and actually kind of challenge yourself to learn it, you're still in the drop add period. You can leave the class, all right? Because seriously, it's going to be a lot of work, all right? So the good news is if you do the work, you're going to actually do things that the professionals do, and you're going to learn how the real world really works, and you're going to learn a lot. But it's going to require a level of effort on your part because we're going to be using Bloomberg for assignments every week, and you're going to have to do it yourself. So you won't be able to have other people do it for you. So again, if you want other people to do it for you, what will happen is if you turn in somebody else's screenshot, you both go in front of the Honor Council with a recommendation to fail the class with an XF on your transcript, which means they won't let you to graduate and your parents are going to hate me, all right? But I'm not going to change it. So it's really not worth it to do that. So when I say individual assignments, you literally have to individually go do it yourself. You can't have people do it for you. Now, there'll be some group assignments this semester, but the majority will be individual. It's the only way you're really going to learn how to do this stuff. So like I said, I'll teach you how to do this. You're going to learn a lot this semester. It'll help you in your careers with your resumes. But if you're not up for that, we're still in the drop add period. Won't hold it against you. Just kind of warning you in advance. But every week you will be using the Bloomberg terminal to do either in-class or homework assignments, right? And they will be real-world assignments. So back to this. Homework 1 will be due Monday. We'll talk about it more at the end of class. Before we do, I want to get into our lecture notes. So today we're going to cover lecture note 1. So I want to start talking about what we'll call the 4 cornerstones of value creation. This class is primarily based on the work that the consulting firm McKinsey & Company does. And I have a great respect for McKinsey because back in the 90s, I was part of the Analyst Training Program for about 3 years. And basically what happens is that they hire you as an undergrad analyst. They'll send you through a 5-week-long boot camp before they turn you loose on the corporate clients. And they basically teach you all the firm's frameworks and just a lot of general business knowledge to get you up to speed. So it's called the ATP, the Analyst Training Program, still goes on today. And they bring in outside faculty as well as internal consultants to train the analysts. I was brought in as an outside faculty member. So I got a great appreciation for what they do, and I was there for the finance week, teaching them how to do financial analysis and corporate valuation. So I kind of learned their processes as well. Now, what's interesting is a good friend of mine, Dave Wessels, at the time was working for McKinsey as an analyst. He was part of the training program as well, and he is now a professor at Wharton, and he is actually one of the 3 named authors on the valuation book, which is our textbook. And so what McKinsey did about a decade ago is Tim Kohler, who runs their New York finance practice, basically wrote a book with a couple of other consultants called Valuation, where they took all of their valuation work as a firm and they put it into this textbook and they published it for the world to see. The book is now in its 5th edition. That's what we're actually using as our textbook. That textbook is used at Wharton because Wessels teaches this class there, and it's used here. Other than that, most other universities don't use it. Because what people don't have an appreciation for is that's what they actually do with their clients. The 6th edition, by the way, is coming out in the next few months. David's actually one of the holdups because they're actually doing a cost of capital chapter. And one of the problems is they're trying to figure out in today's world with negative interest rates and other issues like how to deal with cost of capital on a practical way. So that's actually the holdup. But once they finish that, basically the book will be coming out in its newest edition in the next couple months. But for our purposes this semester, we're using the 5th edition, and some of these premises are timeless. Now, what I think makes them really good is they do a really good job of taking the academic frameworks, putting them into a practical way, organized, and help companies actually apply it in the real world. That's why they're good as a firm. And really, that's what our textbook is focusing on. So there are 4 major themes that will permeate this semester, which they call the 4 cornerstones of value creation, which I'm going to use as an introduction here today. So the first theme is basically this. You don't create value by growing your sales and growing your earnings. That doesn't equal value creation. What's going to matter to the investor is, first, return on investment. How much did you spend to generate those sales and profits? And second, risk. How much risk did you take to generate those sales and profits? Those things are going to be fundamental to value creation. And ultimately, it's going to go down to the concept of what's called spread. What is your, and they call it return on invested capital, against your cost of capital. If the ROIC is greater than the WACC, you will create value. If the ROIC is less than the WACC, you'll destroy value. It's basically NPV, IRR against R, cost of capital. If your IRR is less than your R, you have a negative NPV. Negative NPV is negative value. We're just looking at companies. Companies are basically big NPVs. And so that's the idea. The internal rate of return has to be greater than your cost of capital. The ROIC has to be greater than your cost of capital over time. Otherwise, you just don't create value. So that is going to be a core principle, which is going to be based on a lot of what we're going to be talking about this semester. Second, you don't create value through financial reengineering. All right. Now, this one I want to be very specific on. All right, because many of you are finance and accounting majors. Many of your accounting majors are going to go work for companies like PricewaterhouseCoopers and Ernst & Young, and you're going to be paid a lot of money to basically help companies not pay taxes. All right, and what I'm going to tell you is that is not what I would call value creation. So let me give you an example of what I mean here. So on the whiteboard behind me, and you can't really see it on the video because it's just doing a screen capture, but basically is a box. And what we're going to do is we're just going to do the shoebox method of accounting for our company, right? Because right now, in Europe, for example, in Germany, they have negative interest rates, which means if I put my money in the German central government, I actually make less money in 30 days than I do when I start. And I go in knowing that's going to happen. Now, that's kind of hard to explain in an academic setting, but that's actually happening in the real world today. All right, so Europe right now is struggling with negative interest rates. So let's just say I'm a European company. I don't want to put my money in the bank. I'm going to put it in a shoebox instead. So I'm going to take all my cash profits. I'm going to put it in this box. There's generally going to be 3 people that are going to have access to my box of cash that I'm going to pay out with my profits. Some of it's going to go to the government in the form of taxes. Some of it's going to go to the banks to pay off the debt. And the rest of it is going to go to shareholders or equity. And the combination that it goes to will be dependent on my capital structure, right? But it's those 3 primary stakeholders that are going to have access to my company's profits. Okay, so here's the point. You guys hear about the Burger King Tim Hortons deal, where Warren Buffett and Berkshire Hathaway, along with 3G Capital, are partnering to merge Berkshire Hathaway or to merge Burger King with Tim Hortons? Yes.
Is that the donut place from?
So I was going to say, does everybody know what Tim Hortons is? I've heard it's a Canadian donut shop. So kind of like the Dunkin' Donuts of Canada. Does that sound right? I don't know. People earlier were saying it was a great donut. So great donuts. And I assume everybody knows what Burger King is, right? So basically they're going to put these 2 companies together. Now, they've actually said they're not going to actually create some sort of like, donut burger. They don't really see a big synergy in these 2 companies. That, number one, they're doing it, my opinion, for primarily tax reasons. Even though they said they're not doing it for tax reasons, I actually believe they are doing it for tax reasons. I'll tell you why in a second. And number 2, they're partnering with 3G Capital. And 3G Capital is the second partnership that Warren Buffett's had with them, is a Brazilian hedge fund that specializes in lowering cost. And historically, Berkshire Hathaway has said, we don't want to come in and reorganize the firms we buy and lower their cost and fire management. We're just going to basically take the in-place management because we think they're great companies. We're the finance guys. We're not the operators. So we're going to leave you alone. That's not 3G Capital's modus operandi. They bought Heinz together a couple of years ago, and the 3G people have been going in and they've been gutting Heinz. They've been slashing costs and reorganizing the business. I think that Warren Buffett was impressed with what they did with Heinz, so they're turning them loose on Burger King. So one of the things they're probably going to do is they're going to lower Burger King's cost, right? But that's not what Warren Buffett has historically been about. He's also been against tax inversions, yet they're going to do a tax inversion here. And that is what I want to talk about. What is a tax inversion? Anybody know? Yeah.
When a company merges with or acquires a company in another country in order to pay that tax rate instead of the original country.
That's right. So the deal here is that Burger King is based right outside of Miami, Florida, and Tim Hortons, I believe, is based in Toronto. They're a Canadian company. So by merging these two companies together, what they're going to do is they're going to take the tax jurisdiction of Burger King and they're going to move it to Canada. And it's literally a paper transaction. It's not like we're going to move people from Miami to Toronto. The people in Miami probably like Miami. It's warm, so they're going to stay there. And the people in Canada probably like the cold, so they don't want to go to Miami. I don't know, maybe they do. But in any event, the point is they're not putting them together. They're just going to change the mailing address. And by doing that, the day this was announced, share price of Burger King went up 20%, right? Because of the tax savings involved, right? So here's the idea. The U.S. has one of the highest corporate tax rates in the world at 35%. Canada's tax rate is 27%. So by moving the address, they pay less taxes. The U.S. has a global tax rate. We're one of the few countries in the world that has that, which means that if you do business in, pick a country, Portugal, then we want 35% of the money you make in Portugal for the U.S. taxpayer, right? The rest of the world doesn't work that way. If you're in Portugal and you do business in the U.S., they only tax you on the money you do in Portugal. They don't care what you make someplace else. The U.S. cares what you make everywhere else. We want, if you're a U.S. company, 35% of your profits anywhere in the world. That's our tax code. That's why people don't like it. But this is the interesting part of it. You don't actually have to pay the taxes until the money is repatriated back to the U.S. So as long as the cash stays outside the U.S., you don't pay the 35%. Now, when you bring it back, you can also do a tax credit for whatever country you paid. So if you paid 15% in Portugal, then when you bring it back to the U.S., then you only have to pay 20% instead of 35% because you can deduct what you paid in Portugal, but we still want that extra 20%. So what's happened is U.S. companies have $2 trillion of cash profits sitting outside the U.S. unrepatriated, because nobody wants to take that 35% haircut, and they're hoping for a tax holiday. If anybody's been paying attention to the news headlines, in the 2015 budget that Obama just presented to the Republicans, that by default they said they don't like, right? They didn't even read it. They just said, we hate it, right? It's just our government today. But one of the things in there is an 8.75% tax holiday, one-time repatriation. So for 2015-16 fiscal year, one time we'll let companies bring the money back from overseas and pay 8.75% rather than 35%. And it's to get the $2 trillion back into the U.S. Right? Now, the Republicans have said this is a bad idea, and they're completely against it. What's interesting is the chairman of the House Ways and Means Committee from the Republican side last fall proposed the same thing at a 15% rate. Okay? So essentially, I personally think the Republicans said 15 in the fall. Obama just said 9. A deal's going to be done this year because companies want it, and it's a bunch of money that can come back to the U.S. economy, right? But it's not done yet. But here's the real point. Why is Warren Buffett interested in the tax inversion? Well, if they move Burger King to Canada, then guess what? They only pay 27%. Canada doesn't tax you globally. You only pay 27% on the money you make in Canada. You don't pay 27% on the money you make elsewhere. That's why it's such a big deal. Now, they've been downplaying this, but I think this is what's really important to Berkshire Hathaway, the deal, and it's why the share price of Burger King went up. So here's my point about the box. The reason why Burger King stock price went up 20% when they announced the deal is more cash is coming to the shareholders because they're paying less in taxes. My question to you is, where's that cash coming from?
Was it always there?
It's been always there. Who's giving the shareholders the cash?
The management of the company.
It's not the management. Who is it?
Coming at the expense of the government.
Yeah, it's coming at the expense of the government. So what it really is, it's a wealth transfer. We're taking cash that otherwise would have been paid in taxes and we're putting it in the pockets of the shareholders. Now, don't get me wrong. People are going to pay you, if you work for an accounting firm, a lot of money to do this. But I don't consider this to be value creation. I consider this to be value redistribution. What we're doing, and that's why I like your comment, the money's already there. We're just reshuffling the cash that's already there for our advantage. And I'm not saying that from a shareholder standpoint, there's not some value to the shareholders in doing it. But we didn't make the firm more valuable. We're just taking more for ourselves of the cash the firm has generated. So the box of cash is called enterprise value. So that's the value of the firm. And it doesn't change as we reshuffle the deck. This is called Modigliani-Miller. Real value creation. Give me a bigger box of cash. Give me more enterprise value. Then let me figure out how to optimize the distribution. But optimizing the distribution is not really value creation. Having more cash to distribute is value creation. And that's what we're going to focus on this semester. Third concept. A company's price, or for that matter, the price of any asset, is based on expectations. Right? So here's how you win a Nobel Prize. It's probably too late. But we believe that companies are worth the sum of their future cash flows. All right, and the way that the academics have proven this in their papers and got the PhDs and the original Nobel Prizes was basically they take big data sets of lots of companies for long periods of time, more than 10 years. And they look at the cash these companies generate. And then they see the prices of these companies. And over time, you see a one-to-one correlation. The cash these companies generate are the prices these companies actually traded for in the marketplace. Therefore, the academic said, you're worth the sum of your future cash flows. And to be honest with you, it's intuitive. Because if I'm a company and I generate $1 of cash profit, and you're my owner, I'm going to give you that dollar. And if you sell it to somebody else, somebody shouldn't pay more than $1 for $1. If they do, there's an arbitrage opportunity, and somebody's eventually going to take advantage of that. That's called intrinsic value. All right, so the company's intrinsic value is the cash it generates. And I should eventually pay for whatever that cash is. And eventually, when I see what that cash is, that's going to be the final price of the asset. Here's the one problem with that. Practically, I need to know what the cash is all the way into the future for a long period of time. Today, you're worth the sum of your future cash flows. I have to guess what those cash flows are. So the value of the business is the guesses of the cash flows. Now, most of the guesses that are important because of time value of money is what you earn the first 10 or so years. So here's the interesting thing. If I jump 10 years into the future immediately, the previous 10 years don't matter. It's the next 10 years. What you actually earn historically is irrelevant. What you earn in the future is your entire value. We'll never get to the future. We'll always price based on expectation. We'll never price on actual reality because we'll never have the reality to actually price. So the thing is that prices for any asset is based on expectations. And that's kind of fundamental to understand because the valuation process is actually simple. The formulas are just an NPV. The hard part of valuation is predicting what the cash flows are. Right? It's a little bit easier with fixed income, bonds, because basically bonds promise you what the cash flows are going to be. Now there's some non-repayment risk, but you can generally predict what they are. Stocks are harder, not because the formulas are harder, but just figuring out what a company's actually going to generate is actually harder because we have to guess. But that is why, number one, individually, you are at such an information disadvantage to the institutions because you don't have access into the expectations for the people that actually move the stocks. And that's what Bloomberg starts to close the gap with because that's where a lot of that data exists that the average person doesn't have. So if you're an E-Trade or Charles Schwab, you're just a lamb being slaughtered because you have no idea what the institutions are thinking and you're just making guesses and your guesses have nothing to do with the real world. And that's the other point. It's the guesses of the institutions that matter. So, for example, go to Bloomberg. So let's pick, I don't know, any company. I was talking about Molson Coors earlier today. So let's talk about Molson Coors. In Bloomberg, I go to Molson Coors, and then I type HDS, HDS, which are holders. This will tell me who owns the stock. And one of the things that I can quickly see is that 97% of Molson Coors shares are controlled by institutions. So you and I don't matter. And this has been pretty much true of most publicly traded companies today, is that we don't individually own stocks anymore. We've put our money into institutions. We put it into mutual funds. We put it into hedge funds. We put it into insurance companies. Those are the ones that are basically buying and selling the stock in big blocks, and they're the ones that are setting the stock price. So, for example, Mason Capital Management, who recently bought 2.3 million shares of Molson Coors, this is what's going to move the share price, not what we think of the stock. These are called the buy-side analysts, by the way, that work for these companies. So if you're hired by one of these institutions to do research, you're going to be a buy-side analyst, and you're going to decide, does it make sense to put a stock in my portfolio? So I'm literally deciding whether to buy or sell and what price to pay. That's what the buy-siders do. There's another type of analyst called the sell side. The sell side work for the banks. They're selling to the buy side. ANR gets you a list of the sell side researchers for a company. Analyst Rankings. These are the analysts that are covering Molson Coors. It's Judy Hong from Goldman Sachs, Michael Stieb from Credit Suisse, Ian Shackleton from Nomura Securities. These people don't actually own Molson Coors. They write research, buy, sell, hold reports. They set target prices. They make earnings guesses, and they're selling their ideas and research to the buy-siders. Right? So the buy-siders are kind of consuming the sell-side research. The way the sell-siders make money is through transaction fees. So if I can get you to buy or sell a stock because I'm telling you it's going to move, I don't care what direction it moves, I get a commission on that, and that's essentially how the sell-siders make money. So the sell-siders are judged on whether or not their research is consumed, and that leads to trading activities. So that's the point. The sell-side banks, the trading desks, don't make any money when the stock doesn't move. They just want the stock to move. So when you see huge volatility, then the brokers are going to make a lot of money. When there's a little bit of volatility, nobody makes any money in the banking industry because there's no trading fees. So again, they don't care which direction it moves. They just want it to move. So basically, sell-siders are the ones that are trying to get the stock to move. But here's the thing. The buy-siders pay the sell-siders a lot of respect. Here's why. The number one rated analyst over here, because every guess is tracked in the database, for predicting Molson Coors is Mark, looks like Schwartzberg of Stifel. If I click on Mark, here's his address on Park Avenue, here's his phone number, here's his email. Right? This little red dot means he's got a Bloomberg terminal, but right now he's not logged in. When you see a green dot, you can real-time SMS him. Now, here's the thing. If you call this number, he's likely to pick up. Right? If you tell him you're a student at the University of Maryland, he's likely to hang up. But we've actually had some students who've actually used these numbers at Bloomberg and have gotten jobs by basically just start talking to the analysts and trying to pitch themselves. But back to this. You're not going to be able to talk to Mark, and maybe you will. Right? He might indulge you for a minute. But here's the thing. This is his coverage universe. So he's responsible not just for Molson Coors, he's responsible for these other beverage companies. And that's the point. If he calls Diageo CEO, the Diageo CEO is not only going to pick up the phone, he's going to talk to him for a while about his business. So he's talking to, on a regular basis, the CEO, the CFO, and the head of investor relations of every one of those companies. And that's the one thing that the sell-side analysts have an advantage of that even the buy-siders do not, is that these companies actually spend a lot of time educating the sell-side analysts. But they're also triangulating because they're hearing from Diageo, they're hearing from Anheuser-Busch InBev, they're hearing from Constellation Brands, and if one company is saying something different, then they can actually absorb all that to get a better view of what's happening in the industry than even an individual company can have. And that's why the sell-side researchers become so powerful. So it's not that they own the stock, but they're really a hub that everybody tries to spend time educating. And then what they do is they then use this information to create financial forecasts, EEO, earning estimate overview, income statement and balance sheet forecast on a quarterly and an annual basis in Excel. They then load the forecast into a database. That's the consensus estimate. This is a real-time view into the consensus estimate database in Bloomberg. And in the short run, company stock prices are all about how you did against the consensus, because that's the point. This is the wisdom of Wall Street. And the way that they do it is sales for fourth quarter 2014 is basically expected to be 969 million. How did we come up with that? 9 analysts made guesses. 2 were defined as mathematical outliers. 7 of them's guesses were between 873 and 1009. The average was 969.571. That's the consensus. That's the number that everybody's looking for when it's in the paper of whether you missed or met your numbers. So what you have through Bloomberg is a real-time view into the consensus database. And that is very powerful because it's not just on a quarterly basis, it's on an annualized basis. And this is what's really going to determine the stock price. This is why you're doing StockTrak. Because StockTrak is all about expectations. And in the short run, that's why you can't beat the market. Because in the short run, prices have everything to do with expectations and the changes in expectations. It has nothing to do with your long-term performance. And a really good example of this is a company like Twitter. Look at Twitter today. Twitter, DES, description, their market cap at $40 a share, that's a real-time quote, is almost $26 billion. Right? Twitter's worth $26 billion. What's interesting, if I go to the earnings estimates on an annualized basis, is last year Twitter had, for 2013, they're about to report 2014 any day now, 665 million in sales, 647 million in loss. For every dollar of sales, they had $2 of expenses. They had $600 million of losses. They're worth $25 billion. That doesn't make any mathematical sense. They've never made a profit, yet they're worth more than most companies. Well, how does this happen? Well, by 2017, Wall Street believes they're going to get $4.7 billion in revenue and $1.775 billion of pre-tax profit. So people are buying them not based on the losses they've had, but in 3 years, they're going to get almost $5 billion of sales and over a 20% operating margin. That's why they're buying Twitter. And that's why they're paying $25 billion for Twitter. But what I'm telling you is as new data comes out and people realize that this is not what's going to happen, that's what's going to cause Twitter's stock price to go up or down. So if Twitter starts doing a lot better than people expect, then the share price is going to go up. But if Twitter does a lot worse than people expect, they could still hit $4 billion in revenue in 3 years. But that's a lot worse than what people thought. Now's a good time to get out of Twitter. So that's the point. In the short run, it's the expectation game. And we have to understand that if we're really going to understand the valuations of stocks, how these are set, why they're changing, when they're changing, and how they're changing. So that's the third point. Point number 4, competitive advantage. Over the long run, you're going to see regression to the mean in any industry. It's also in the book. And the idea is you earn an average rate of return over time. So, question becomes, how long before you start earning an average rate of return? And the only way you do above average, if you have some form of competitive advantage. So what is a company's competitive advantage and how long does it last? The historical definition of competitive advantage was the moat theory. The idea is you build a big scary moat around your castle to keep people away. And then, according to Warren Buffett, you have a knight in your castle ever expanding your lands. You get that, you got a great company. What if your castle is in a place that nobody cares about anymore? Doesn't matter what your moat is. 2007, BlackBerry controlled 70% of the worldwide smartphone market. If I told you that BlackBerry would cease to exist 7 years later and basically be on the great scrap heap of companies and be about to bought for Samsung for pennies on the dollar, you would have laughed me out of the room. You're like, what kind of quack is this? As you're typing on your BlackBerry phone. How many people in this room have a BlackBerry phone today? It's okay. You can admit it. They have 1% global market share, which means technically 1 out of 100 people should have one. 7 years. No matter how good Apple is doing today, I can tell you in 20 years they're not going to be doing as well. That's the problem with the moat theory. So what we're now going to start using, and I have a colleague named Rita McGrath. She's a Wharton PhD. She's now at Columbia. And she just wrote a book called The End of Competitive Advantage. And what she talks about is the wave theory. And the idea is it's all about time. That competitive advantage is like a wave. The wave is going to crash. And you need to be like a surfer. You need to be thinking about the next wave, right? Because how long can you have that competitive advantage is going to matter. And then do you have the ability to then generate another competitive advantage? So that's going to happen, and that's going to be very important to investment selection and investment evaluation. So this framework is what's going to ultimately matter. There's a lot of math we're going to do this semester. It's all based on this framework. And what it says is there's 3 things that drive value in a business. The first is spread, right? ROIC versus WACC. You don't have that over time, you can't create value. Right? It's NPV, basically. NPV 101. Number 2, growth. Growth does not create value. I'm going to say that again. Growth does not create value. Growth is an accelerant to value. It's like throwing gasoline on a fire. If I have a negative NPV and I grow it, I'm just going to go bankrupt. There's nothing I can do to create value if I have a negative spread. My IRR is consistently less than my cost of capital. I just destroy more and more value by taking on more negative NPV projects, right? If I have positive NPV projects and I take on more of them, I start to exponentially create value. So that's the point. Growth is the accelerant. And so it becomes the growth spread combination that really matters to value creation. And then finally, sustainability. How long is that growth going to last? How long is that positive spread going to last before there's some regression to the mean? It's interesting that Samsung thought they had competitive advantage in the smartphone market, yet their profits have dropped for 6 quarters in a row, and their operating profits are down 30%. What's their problem? Specifically, which iPhone?
6.
Why?
Because it has a bigger screen, so it's taking away from their
Yeah.
target market.
Basically, Steve Jobs was stubborn, and he didn't want to have a big screen. So Samsung took advantage of the fact that they didn't have a big screen. And they did really well until Apple introduced a big screen iPhone. And now the Samsung Galaxy is in trouble because people with the big screen are generally choosing the Apple over the Samsung once you put the screen size out of the way. So when Samsung had the screen that Apple didn't, people were buying the Samsung Galaxy. Now that you give people a choice, they're moving over to the iPhone 6 Plus. Right? Not saying Samsung's not selling any phones. What I'm telling you is they were doing really well because Apple didn't have that product. And I'm just saying it would be naive to assume that Apple wouldn't eventually figure this one out. Matter of fact, you want to hear an interesting rumor? I don't know if this is going to be true, but it wouldn't surprise me. Apple's going to come out, the rumor is, with an iPad Pro. You know what's different about it? Besides the fact it's a 12-inch iPad? It's going to have a stylus. They made fun of Microsoft for having the stylus. But you know what? The Surface Pro 3 is catching on with consumers. And Apple's iPad sales are shrinking. And Microsoft is actually finally starting to see success in the tablet market because people like that stylus. So Apple, right now, is beta testing a stylus with the Mac Pro 3. It's talked about on the blogs. So again, competitive advantage. I can be stubborn, but eventually, if I realize the customer wants something, I'm going to change my ways. And people are going to copy me. They're going to do what I do. So we have to constantly be thinking about sustainability with any business. So here's the final piece, which ties into our homework that we're going to cover today. We're going to pick up here on Monday. But this is kind of a very important slide. So this is a true story. It actually happened in the Bell Atlantic classroom at Wharton in 2008. So I was actually doing a seminar for the senior leadership of Company A. And the CFO of that company was in the back of the room. And he asked me a question which led to this slide, and it's actually a very important slide. And his question was basically this. Company B is our main competitor. So these are two companies in the same industry. You've actually heard of both of them, right? And we sell the same products. Because we're peers, we have the same cost of capital, same risk, and we have the same profit margins. We both make 8% after-tax operating margins on our business. So everything I say with this story, the analysts agree with. They agree that we have the same margins, same growth rates, same risk, yet they're saying my stock is going down and my competitors is going up. He's like, you work with the Wall Street analysts. Why? Why do you think this is happening? So I asked him a very simple question. And I said, what's your cycle time? And he said, what do you mean by cycle time? And the reason I say that is because that definition is used exclusively in this class. This is Joe's definition. It's not a Wall Street definition. It's not a Bloomberg definition. And what I define cycle time in days as the time it takes to get $1 of borrowed money that you put into your business converted into $1 of collected cash from your customer. How long does that take? That is the cycle time, which is measurable in days. That's the formula to measure it. Two parts of the formula. What is my invested capital, the borrowed money that I've put to work in my business? What is my annualized sales or revenue? Divide percentage of the year that I'm financing times 365 days. Right? Wall Street doesn't call it days. I believe language is important. And I think it's easier to understand language. In a previous class, we probably talked about inventory turn. My inventory turn was 7. The average person hears that number and they have no comprehension of what that means. If I tell you that your inventory turns every 43 days, my brain intuitively understands that. It's saying the same thing, but it's easier language. So when I talk about productivity of an organization, other people will say my productivity is 0.5. I don't know what that means. But if I sell my product in 730 days, it's the same thing. So that's what we're going to use for our language in this class. That's one of the custom formulas you're going to put into Bloomberg. Cycle time. How long it takes to turn $1 of investment into $1 of collected revenue. And what it's based on is cash flow valuation. Cash flow valuation is really two things. One, if I put $1 into the business, does more than $1 come out? And two, assuming more than $1 comes out, is it enough to compensate for the risk? That's what cash flow valuation is. So I'm just addressing the first question, and what I'm asking is, how long does it take to get the $1 back? If I put $1 in, how long does it take to get my money back in revenue? Investment to revenue, cash cycle. So, 30 seconds, CFO got it, including everybody else in the room. I said, let's go get the annual reports out, got the 10Ks, downloaded them from Edgar, and we literally calculated his and his competitors in front of the class in Excel. His was 267 days using that formula. His competitor was 135. Here's the business model. I give you $1, you make 8 cents every 267 days. I give your competitor $1, they make 8 cents every 135 days. Where would you put your money? Where would you put your money? Even the CFO of Company A admitted B was a better investment, but he did say that they have more upside. Okay, it's Company A. But back to this. So, I want you to understand how this works mechanically. So let's say both companies start working on their products in the same day. On day 135, how much cash profit does A have? It's actually 0. All right, the accountants in the room are like, it's 4 cents. All right, but that's just a piece of paper accrual that you're doing. The actual cash is not collected. You're still waiting to be paid. You're not done. So it's actually 0. All right, is everybody clear on that? On day 135, how much cash does B have? They get $1 of revenue. They spent 92 cents of cash along the way. They now have 8 cents of cash profit. Right? This is after tax, by the way. On day 267, what about A? They now get 8 cents. On day 270, what about B? 16. Because they basically get a second cycle of 8 cents. So they get 8 cents twice. So what matters in finance isn't just how much you make, it's how often you make it. Those are the two things that really matter. So for comparative purposes, for cash flow purposes, we annualize this data. 8 cents every 267 days is 11 cents a year. 8 cents every 135 days is 22 cents a year. For the same investment, would you rather have 11 cents of cash or 22 cents of cash? Pretty obvious, right? That annualized number is ROIC. That's return on invested capital. It has two drivers: margin, how much, cycle time, how often. The annualized amount is the annualized cash you're generating. That's the ROIC of the business. That's why ROIC is such fundamental to what we do this semester, because that's the cash flow that's eventually going to go to the investors, and these are the things that are going to drive that cash flow for a business over time. That's the insight that we're going to have about companies. Now, here's the other interesting part of this. So, last February, I was invited to speak at the Molson Coors leadership meeting. And basically, the reason I was invited to go in is that Molson Coors is the worst performing beer company in the world. We are in the golden age of alcohol, where any alcoholic beverage company is just printing money hand over fist. It's been growing very, very rapidly. Molson Coors, if you put your money as an investor, you actually lost money. You have the worst total return to shareholders of any beer company. They're just doing terribly, while everybody else is doing phenomenally well. So I was basically brought down there to rain on the parade and basically say, you guys suck, right? And actually, they wanted me to come in and say that, because basically they didn't want to say that to their own people, because if you've ever been to a leadership meeting at a beer company, it's just like a spring break party. I mean, we're down in Fort Lauderdale. The difference is, instead of a bunch of teenagers being drunk, you got a bunch of 50-year-olds being drunk. But it's the same general idea. I mean, they have loud music, there's beer everywhere, it's a fun time, and they have Joe in front of the room saying, you guys suck, right? So here's why they thought I need to come in with that message. So again, I'm in Bloomberg. I go to TAP, which is ticker symbol for Molson Coors, U.S. equity. I go to the RV screen, which allows me to quickly compare against multiple companies. I go to the custom screen, where I can see whatever variables I want. And I go to Bloomberg peers. As a matter of fact, I'll go to global peers, not just U.S. companies. So look at a global list of peers, mostly beverage companies, beer, wine, and like people like Coca-Cola. And I'll put in a column. Oh, by the way, in settings, under display, I also do market cap weighted average as a default setting, so I can always see what the industry average is at the top by default. So add column, ROIC, return on invested capital, and we're going to do this pretty consistently, latest year, latest annualized data reported. Hit enter. Then I'm going to do weighted average cost of capital. Get a spread. So, global beverage industry last year, 12.3% ROIC. Cost of capital, 7%. This is a positive spread, good industry to be in. I can borrow at 7, I can make 12, and it's a growing business. And I'll just do more of that all the time, create a lot of value. Molson Coors, 8.6% cost of capital, 5.4% ROIC. Borrow at 8, make 5. How's that sound? Should I do more of that? See how easy it is to deliver this message? That was the message they wanted. They had a Bloomberg terminal in Colorado at their headquarters, and this is the data they saw themselves, and they just wanted somebody as an outsider to come in and make the message sound simple. And it was. So the message should be to what? What do I tell the salespeople in the room? What would you tell them with this data? Beyond stop doing this. Do I want to grow? Growth is value destructive right now. That's why your stock price isn't doing well. That's why there's investor pressure on you. So You got to be much more careful about the growth. We're going to have to restructure. We're going to have to cut back some things. We're not doing a good job. That was the message they wanted. So I started doing my homework, and this is the message I actually delivered. You guys aren't growing fast enough. You should grow faster. You're doing an amazing job. You're a great company. And I'm not saying this for a fact. I actually believe this. You're a strong buy. Sell more beer. Why? Well, this has to do with the difference between, and this is a McKinsey approach, operating ROIC and ROIC. What you learned in other classes, what Bloomberg uses as a default field, and I spent 30 minutes at the end of this class yesterday talking to Bloomberg people about why they need to put in an additional field into their screening tool. But in any event, the problem with ROIC, which is taught in every class and used professionally on Wall Street, is that it is the return on the debt and equity of the business, right? Which equals all the assets of the business, because the balance sheet has a balance, minus the non-interest-bearing liabilities. But here's the problem. It's all of the assets. So if I look at a company like Apple that's got a huge amount of cash sitting in Europe, just collecting a little bit of interest because they don't want to bring it back to the U.S., the return on their investment is going to include all of that cash sitting in a bank. Well, that has nothing to do with how many iPhones and iPads they sell. And what that return on investment tells me is to sell another iPhone and iPad, they need another $170 billion of cash. It doesn't make any logical sense, yet that's the way we measure companies. We look at their return on their debt and equity because we don't separate out the operating and non-operating assets. So what I'm going to teach you how to do this semester is to differentiate between those two things. What are the operating assets that are actually required to do the business? In their case, make and sell beer. Versus what are the other non-operating assets that have nothing to do with the sales of your business, that are just other things that you invested in. Another example of this, joint ventures. I own a joint venture. I don't run it. I don't manage it. It has nothing to do with my core business. I just happen to have an investment in another business. Non-operating. Has value. Has nothing to do with my business. Yahoo's an interesting company. Yahoo is a worthless business with no competitive advantage, and they're probably going to be gobbled up by somebody else pretty soon. And Marissa Mayer, who's probably a wonderful woman who came over from Google, is eventually going to get fired because she has not been able to turn it around. And the reason I can say this with such conviction, if you guys actually are interviewing for Yahoo, I'd say pick another company, is because they don't even own their technology anymore. If you use Yahoo Search, you're actually using Microsoft. They're just private labeling Microsoft because they have no IP. They've made huge acquisitions. And almost every acquisition they made has completely failed because what they'll do is they'll buy a great company and then they'll shut it down 18 months later. They're really good at doing that, with one exception. They got lucky. Who did they buy that got lucky for Yahoo? Alibaba. They invested in Alibaba a while back. They owned 30% of the company when Alibaba was young. And the entire value of Yahoo is 30% of Alibaba. They're like a tracking stock. So basically, Yahoo's value comes from owning 30% of Alibaba. Now that Alibaba's public, they're going to sell it off. They're going to take the cash. And basically what the analysts have said, please don't use the cash to buy in other companies. Please distribute this. And basically what the CEO said is, yes, we will distribute it. We won't buy the other companies. So, because we're really bad at buying companies. And then they're very excited. But if she actually starts buying other companies, then they're going to call for her resignation, because they have such a terrible track record of buying companies that they don't want them to do it. Now, if they spend another $100, $200 million buying some little startup, they don't care. But it's when they start spending $1 billion, $2 billion, $3 billion, and they waste the money, that's what people are really caring about, because they just had no track record of buying companies historically that have been successful. So, long story short, probably not going to be invited to work with Yahoo, by the way. But back to this. Why could I say with conviction that Molson Coors should grow? Well, what I did, and this is part of your homework assignment, is I calculated the operating ROIC, which is a McKinsey-based framework to look at just the return of the operating assets, the beer business, separate out the non-operating assets, put it in as a custom field in Bloomberg, which doesn't exist for you guys yet. It will by Monday. And that gave me an answer of 17.5%. I have a beer business that's making 17.5% on an 8.6% cost of capital. Why would I want to slow that down? This is a great business. Why does the company make 5% when their core business is making 17.5? What's the problem? Yep.
They have a lot of idle investments.
It's the non-operating stuff. And specifically, they have a joint venture with SAB Miller. And it's a big black hole for cash. They put in hundreds of millions of dollars in this joint venture. It's not making any money. So I got 150 people in the room, top leadership of Molson Coors. How many people do you think decided to do this joint venture? Exactly right. Very senior leadership made that choice. Not the people out there making and selling beer. So what the message was supposed to be is the people making and selling beer, you guys suck. What the message turned out to be delivered is, you guys are doing a good job. The joint venture is the problem. Probably one and done with Molson Coors, right? But regardless, if I'm an analyst, here's what I need to know. This is the difference between a buy and a sell. Because I would say buy Molson Coors, because if they fix the joint venture or at least stop investing in it, and they keep growing their beer business, making 17.5%, the ROIC of Molson Coors is going to start trailing up. It's actually going to be a really good time to buy Molson Coors. Oh, by the way, as they stopped investing in their joint venture, let's see what's happened to them in the last year. Why? Because they're generating more cash flow. And the reason they're generating more cash flow is because they're selling beer at 17.5% ROIC. So on the surface, a naive analyst would say this is a terrible company. But if you really understand the business, this is a great company that happened to make a tragic mistake on a joint venture that did not work out. We need to be sophisticated enough to differentiate between those two. And that is what I'm going to teach you how to think about this semester. And we're going to start with homework assignment number 1. So in order to complete homework assignment number 1, we need to start changing our view of the companies we're looking at. So again, when you get to homework assignment 1, what's going to matter is we need these custom fields that don't exist in the standard Bloomberg database. One of the nice features of Bloomberg, though, is by account, you can create your own custom fields. So you can go in, put in your own custom fields, and again, they'll work in real-time searches and data. So this is what your homework is going to be. You're going to have to put in these custom fields. Based on these custom fields, you'll then do the 2 screens that I want. Now, where in Bloomberg do you put in the custom fields? Well, the simplest place to do it is EQS, which is the equity screening tool. Okay, this is what you started to get a preview on Monday from Bloomberg. So basically, this is a powerful part of Bloomberg, but it's also one of the 3 areas that you can actually create custom fields, right? And custom formulas. So this is where you're going to actually go. So, as an example, one of the custom fields is to create NOPLAT, as we define it, McKinsey NOPLAT, as opposed to NOPAT. So, formula, click on formula, or type in 98. It'll bring you to this screen. All the custom fields that you've previously created, which shouldn't be any, but I have a bunch, are over here on the left. And then on the right is where you can start creating the custom field. Now again, little quirk, you actually have to type in the formula and then name it. If you try and name it first and then type in the formula, it won't work. All right, just the way Bloomberg is set up. So you create the formula first by clicking on this field. So what is my formula? Well, if I go over here, one of the formulas I need is NOPLAT, and it says latest FY, fiscal year, operating income or loss. FY is latest fiscal year, okay, which is most of the way the custom fields are going to be done, times 1 minus the latest fiscal year effective tax rate divided by 100. So here's what we're going to do for NOPLAT. Easiest way to do this is to type ? go or enter, and that will show you the fields that are in the Bloomberg database. So I can use an existing field. So one of the existing fields that I do want to use, since I don't have to necessarily know the field, is operating income or loss. So I start typing in operating income or loss. All right, I click on it. I can see the definition over here, but here's the other part. Select the period. Which operating income or loss do I want? I want the one for the latest year. Okay, so that means last reported year. Select it. It's now here in my formula. Now the friendly name of the field is down here, but the actual database field is up here. So that's my operating income or loss. And then what I'm going to do is I'm going to multiply that by left paren 1 minus, and then same thing, shift question mark, or question mark go, and effective tax rate. And again, for the latest year, select, right? And back to this, I want to then take the latest effective tax rate and divide that by 100, because the number is going to be something like 34 as opposed to 0.34. So what I'm going to then do is I'm going to take a left paren, divide by 100, right paren, make sure I have enough parens. Now, whatever reason, Bloomberg will sometimes tell you have an error even if you don't, because it doesn't always refresh in real time. So the simplest way to do this is if I think I'm right, and if I want to be extra cautious, I'll put a paren around these. Just make sure I have the right order of operations, times that, and then literally just hit save. And then if it has an error, it won't get you this screen. If it does, then I could basically call this my no plat. And what I'm going to do is I'm going to call this my no plat 301 because I already had no plat in my custom fields. And then just hit name again. Why, I don't know. They don't have a save button, just the way they do it. And then now, no plat here 301 is my custom field in my database. All right, so what you're going to do is you're going to do this process for those ratios. Okay? Once you've completed that, then you're going to go back and do the custom screen. So, custom screen number 1 in the S&P 500. So go back to my custom screening area, and I can either scroll through this or type in a criteria. I can either type in S&P 500 or SPX is the ticker for the S&P 500. Click the S&P 500 and then hit enter, and that'll tell me, oh, there's 502 companies in the S&P 500. Right? Why there's an extra 2 companies right now, don't really know, but apparently S&P hasn't knocked out the 2 that they replaced. So those are the 502 people in the S&P 500 index right now. Then what I want to do is I want to add my next criteria. My next criteria is going to be that have a cycle time less than 50 days. So again, you're going to have to put the custom fields in to do cycle time, but I'll add my criteria for cycle time less than 50. Enter. Well, that means I'm down to 19 companies. Next, I do ROIC greater than 20. So I put in my final result. That's the answer, which I'm not going to show you because it's on the video and you got to do it yourself. Right? But once you've done your final screen, you'll have less than 19 companies. Click on results. These will be the companies that is your answer for screen number 1. In the upper right-hand corner, there's an export button in Bloomberg on every screen. If you click on it, save screen as a file. That's how you take the easiest screenshots. Save it as whatever you want. So screen 1, screen 2. Okay? Then you'll upload both of those screenshots to Canvas. You've then completed homework 1. In order to do this, you'll obviously need to use Bloomberg, and you'll have to do this by 10 a.m. Monday morning. And then we'll discuss this in class. But this is a very, very powerful tool in general for screening because you can screen on anything, including the custom fields. Yes?
Is this room open like all weekend?
My understanding is this room is only here during the middle of the week, so Monday through Friday. The lab downstairs is supposed to be open on the weekends from, well, they say 6, but I'd say 9 to 5. Sometimes the people there might leave a little early. But generally it's supposed to be open. That's my understanding. But my recommendation, try and do it before Friday. All right. Generally, this room is locked. If the people across the hall are feeling nice, they'll let you in when there's not a class in session. And the primary reason is we have had theft. People have literally come in here and taken these screens and walked out the door. So, because that camera up there doesn't work. So I know it says this room is under 24-hour surveillance, but in today's budget cutting world, I don't think they're really surveilling the room. So they just keep it locked. So if you can talk the IT people into letting you come into the room, you're welcome to use this room too. Generally, the lab tomorrow is open, and including the weekends. They just don't have somebody to staff this room on the weekends. But nonetheless, you'll be doing Bloomberg assignments pretty much every week. So this is just a good example of trying to practice to do this. The TAs have office hours today and tomorrow. So you probably missed today, but they do have office hours tomorrow. The other thing is, and I'll be very clear about this, click on the question mark on any screen to get Bloomberg help, live help. The help people are actually helpful. They really are. And they're business helpful. So if you say, look, I'm trying to create a custom field and I need some help doing it, and you tell them what you want to do, they'll literally walk you through how to create these custom fields. So in addition to the TAs who had to do this last semester like you do, and the video, which you have Monday's video as well as this video to help you, you can use the Bloomberg help. And here's the other thing. You can use each other to help you. However, just to be very clear, you individually have to create your own custom fields, and you individually have to take your own screenshots. You can't use somebody else's screenshots. So you can help each other, but I do want you to learn how to do it yourself, because if somebody else does this for you, you just won't know how to do it. So that's what I mean by this class this semester. It's not that I don't want you to have help, but I really want you to learn how to do this stuff. And the only way you're going to learn is by doing it yourself. So even in your groups, you're going to have to do a lot of stuff individually just to keep practicing with the terminal. Okay? If you have any questions, you also send me an email. Otherwise, we'll see everybody on Monday. And I will put this video up on YouTube with a link in the next 20 minutes or so.